Good afternoon, everyone. My name's Mitchell Sneddon, and I'm the Head of Portfolio Services here at InvestSMART. Now, what we're going to be going through today are the InvestSMART portfolios. So they're the exchange-traded fund-based portfolios that we use here to give people broad, diversified exposure to various different investment markets. So I'm going to be going through those, doing a bit of a deeper dive, show you the exact ETFs that we hold, the weightings that we hold in each sector and region. And as we're going along, please feel free to submit your questions in the question box just below. So I'll get to those questions after I've gotten through the formal part of the presentation, which should only probably take around 10 to 15 minutes. It's short and sharp, but with the more questions that you have there, of course, the longer we will go for. So do send them through as we're going along. Now, the very first slide I'm going to put up, and if anyone's seen any of my presentations before, they know this, that it is the most important slide. It's our disclaimer slide. So we might be talking about a few stocks, we could be talking about some exchange traded funds, and we'll be talking about general investment advice as well. Now, as the name suggests, it's general advice in nature, so it doesn't take into consideration any of your personal circumstances. So please read this disclaimer through, and maybe even flick back to it at the end, and we'll send you, of course, a copy of the slides as well, so you'll be able to look at it later on too. So just to cover myself, just in case I get a bit carried away. So the first slide here that we have is what we're going to be covering off today. And as I said, we're going to be having a look at our diversified model portfolios. Firstly though, this is kind of come off the back of our roadshow that we just did around Sydney, Melbourne and Brisbane. A key part of that roadshow was our CEO, Ron Hodge, presenting on diversification within your portfolio. So I just want to rehash some of what he was talking about and go back over a few of his slides that he used during the presentation, just to really emphasize how important diversification is with some hard and fast numbers there. As well as in part of that, we're going to be going through the rebalancing aspect of things and why that is so important as well. We're then going to go in and I'll tell you about the individual ETFs that we've chosen to use in our portfolios and how we actually choose those. I'll go into a full breakdown of two of the investment portfolios, the InvestSMART Core Growth portfolio and the InvestSMART International Equities portfolio. And then I'll also go into how you can use these portfolios either as standalone, or you can combine them with other things that we're doing or you might be doing outside of us. So if you're using a different fund manager as well, or if you're using, say, the Intelligent Investor income portfolio or the growth portfolio, or you're thinking about combining them, how you can go about doing that. And of course, we'll just have a bit of a general chat about the overall structure in which we operate these in. Now, as I said, as we go along, send through your questions, and afterwards, even when we're finished, if you still have more questions or do want to chat about this, you'll see a little green circle down in the right-hand corner of your screen. That's a little chat box. If you click into that and start typing any questions away, you'll be able to get through to me and my team, and we'll be there ready to take your questions, have a bit of a chat afterwards as well. Okay, so going into this next slide here, we've got why does asset allocation actually matter? Now, as I said, this is rehashing what our CEO Ron Hodge talked about at the Brisbane and Sydney and Melbourne presentations. Now, the first slide as part of this is showing you the 1 year performance, and this is 1 year performance across different asset classes. So you can see on the right-hand side, we've got the Australian equities, we've got the international equity as represented by the MSCI World ex-Australia Index. We've got a property asset class there as represented by the ASX A-REIT asset class. We've got fixed interest, which is bonds. We then have cash. Then we have, on the left-hand side of this picture, we have our different diversified models as represented by what the Morningstar benchmarks are. Now we've got Morningstar's diversified high growth, we've got diversified growth, diversified balanced, diversified moderate, and diversified conservative. Now these are all made up of different asset classes. Those asset classes, of course, are on the right-hand side of the screen. Now, the more high growth the diversified portfolio it is, the more Australian equities and international equities will be in there. So as you can see, in the last 12 months, the best performing asset class when this particular slide was produced was Australian equities, closely followed by international equities, and hence why the diversified high growth portfolios would have achieved the highest rate of return over that 1 year period. The diversified conservative has got the lowest return. That's because it's made up of more of, say, cash and fixed interest. So much more stable, but a lot less return there. Yes, they will have some aspect of Australian equities and an aspect of international equities in there, but nowhere near as much as the diversified high growth. Now, the diversified high growth does have cash and fixed interest in there, but just at a much lower rate than the diversified conservative portfolio. So just remember these, what has performed in this first year. We'll jump ahead now to the second year relative performance page that I've got here. So you can see none of this has changed. All the asset classes are the same at the bottom. But if we take into account the last 2 years, we see that property has been the best performer. Australian equities third, international equities second. So what that does to our diversified portfolios over on the left-hand side, those ones that have slightly more property and slightly more international equities and Australian equities, of course, have done better than their counterparts. Now, the conservative portfolio has ticked up a little bit. It's caught up a little bit to our diversified high growth portfolio because property, fixed interest, cash, etc. has done not so bad compared to the international and Australian equities. And in the balanced one there, we're sitting, of course, in the middle where you'd expect it should be. Now, going out to a 5-year period, a 5-year time frame, this is where it starts to look a little bit interesting. Over the last 5 years, international equities have been the highest performing asset class, closely followed by property, then followed by Australian equities, and of course cash and fixed interest at the back there. Now, what we're seeing here is the portfolios with a better balance between the property, Australian equities and international equities are starting to perform better. So you're seeing that the high growth portfolio here is getting you, of course, not the returns that the international portfolio is achieving, but it's achieving a nice mix of returns between the Australian equities, the property, the international, and stabilised by a little bit of cash and fixed interest holdings that it does have. Of course, then, as you can see, it tapers off with a diversified growth, balanced, moderate and conservative, as you'd expect it should. Now, this 10-year page really puts it all into perspective for us. So if you are looking for a legitimate set and forget style investment approach, looking at, say, a conservative, balanced or a growth style multi-asset portfolio could very well be a good right approach for yourself. Because what we're seeing here is over the long haul, yes, each asset class individually has taken it in turns to be the better performer, but over the long haul, those with a good mix of those asset classes have actually performed quite well. So over this 10-year time period, you can actually see that fixed interest has outperformed all of the other asset classes. But the diversified high growth, the diversified moderate, the diversified conservative, they've captured a lot of growth, a lot of returns there as well. And so what you're getting is a nice smoothed out return without the volatility by holding a broad range of these asset classes. So you could try and pick between, I think Australian equities is going to outperform this year, or international equities is going to outperform this year, and try and shift your exposures, or you can just settle for a diversified portfolio and know that in the years where you might not capture as much growth, you'll make up for it in others by having that diversified portfolio. Now, let's talk about rebalancing, and this particular slide that I've got up here shows a portfolio health check that we have available to you in our portfolio management tool. If you haven't checked that out, please go there and have a good play around with it. The portfolio health check, this particular one, is showing what a balanced portfolio would look like back in 2001. Now you can see if I was chosen a balanced portfolio back then, I'd have a good mix of Australian equities, I'd have a good mix, a little bit of international equities, a little bit of property, a bit of cash and a bit of fixed interest. Now, this is showing me that this portfolio is achieving a score here of 98%. That is very close to perfect. Of course, when you're putting in your portfolio into the portfolio manager, we don't expect everyone to be at 98%, but the closer you can get it there, the better. Because watch what happens when things start to get a little bit out of whack. Now, the next slide shows what this exact portfolio would look like if I hadn't touched anything in 2007. So from 2001 to 2007, I haven't touched a thing, and I've let the portfolio grow. Now, as you can see, the Australian equities component and international equities component has become a much larger portion as a percentage of my portfolio. The cash and fixed interest and property has really declined. Now, what happened after this particular period in time? Of course, we had the GFC. Now, if I had this exact setting in the GFC, my losses would be far greater than if I had rebalanced over the period of time between 2001 to 2007. And if I had rebalanced over that period of time, what I would have is more money in cash and fixed interest ready to potentially tip into equities as they dropped during the GFC. So as the equities drop during the GFC, the Australian equities and international equities as a percentage of my total portfolio balance will decrease, which means the cash and fixed interest component will naturally increase as a percentage. That will force me, if I am rebalancing, to tip out of cash and fixed interest and into international and Australian equities. Okay, so that would actually, if you know what happened during the GFC, that would actually put me in a pretty good position, because I would be deploying capital into the crash and be able to rebound very nicely out of it. And then, of course, I'd be looking to rebalance because the Australian equities and international equities component of my portfolio will grow, and then I'll be able to take some profit from there. So that's really the importance of rebalancing, and that's what we do within our portfolios. So say, for example, if the Australian sector was to rally incredibly hard compared to its global compatriots, we would look to rebalance from our Australian equity exposure into our international equity exposure, which would then be undervalued, or of course into cash, fixed interest and property. Okay, so that's what we do for our clients who are invested in our diversified portfolios. Now, we'll move on to the breakdown of the core growth portfolio. What I've got here is just over these next two slides, I'm actually going to show you every position that we have in this particular portfolio. Now, when it comes to selecting exchange traded funds, and that is what we use for these portfolios, the reason why we use exchange traded funds and not actively managed portfolios is because we want a passive index tracker here so we're not having to second guess what a particular manager, etc., is doing or what exposure they've got. We want the exact exposure so our investment team can sit there and do the right asset allocation for our diversified portfolios, and so you know exactly what you're getting as well. So what we look to do is basically around the different asset classes when we're choosing an exchange traded fund, we look to include the largest and the cheapest. Now, it's that simple when it comes to using an exchange traded fund. Why we want the largest? Because we want I've forgotten the term. We want less tracking error. Okay, the bigger it is, the likelihood of the less tracking error it has. Now, why are fees important to us? Well, fees are important because the lower the cost of the portfolio, the lower the fees coming out of it, the less it will the closer that fund will track the index. So an exchange traded fund will track the index, and should track the index spot on, minus the cost of its fees. So for example, here I've got the iShares Core S&P ASX 200 exchange traded fund. That makes up our Australian equity exposure in our diversified portfolios. That has a MER, which is a management expense ratio, of approximately 0.15 to 0.16% per annum. So that means that it takes a management fee of 0.16% per annum. And so that means, theoretically, this particular portfolio should underperform its benchmark by 0.16 or 0.15% per annum. Now, the other portfolios that the other exchange-traded funds that we use here for our international exposure, we have three. We have the Vanguard All World ex-US Shares Index, we have the iShares S&P 500, and we have the Vanguard European Shares Exchange-Traded Fund. So all pretty self-explanatory in the title, but of course the iShares S&P 500 tracks the S&P 500, incredibly cheap. MER 0.04% per annum approximately. The reason for that is just because of the size. Okay, there's a set cost to running these things, and the bigger you can get that portfolio, the lower the management expense ratio can be. The Vanguard European Shares Exchange Traded Fund, basically that tracks the major European markets, and the All World ex-US Shares Exchange Traded Fund does have a slight percentage of Australian exposure in there, but very, very small, considering we only make up approximately 2% of the world's global markets. The All World ex-US Shares, we use that one to capture the rest of the globe. The reason, of course, we have ex-US is because we already have that iShares S&P 500 Exchange Traded Fund there as well. Now, going into the rest of the portfolio and the core growth, over onto our next slide, we use the Vanguard Australian Property Securities Index Exchange Traded Fund to give us exposure to the property markets. So this gives us exposure to the largest listed real estate investment trusts on the ASX. We use also for our property exposure, we've got exposure to the Van Eck Vector's Global Infrastructure Exchange Traded Fund. So what this is giving us exposure to is infrastructure across the globe, as the name would suggest. So you're looking at transport, global utilities, pipelines, gas lines, that kind of thing. And then we've got the Beta Shares Australian High Interest Cash. AAA is the code for that particular one. Now this is what we use for our cash exposure. What that of course goes and does is it goes out to all the major banks and finds the best term deposits, so we don't have to find them. So when you buy into AAA on the market, what you're doing is you're putting money into term deposits. And if you have a look at the AAA share price over say a 6-month period, what you'll see the share price doing is it's day by day it's ticking up, and then at the end of each month it drops down, and then it starts ticking up again. Now the ticking up is the accruing of the interest each month, and then when it drops back down, that's when it pays out the interest each month. So the AAA share price looks like the edge of a saw. Now, to round that out, we also have the iShares Core Composite Bond ETF as well. So this invests in Treasury and government bonds. Okay, very difficult, generally speaking, for the standard man on the street to go out there and buy government bonds. If you want that exposure, the iShares Core Composite Bond ETF is the way to go. Now, to round that out as well, we do use the Macquarie Income Opportunities Fund. The reason why we use this is because it gives us access to global credit-based securities, so global bonds, but as well we have, like, say, global hybrid stocks in there as well, and other corporate debt instruments. So that kind of rounds out our fixed interest component of our core growth portfolio. Now you can see the management expense ratios for the various ETFs on the side there. The Macquarie Income Opportunities Fund is the highest. The reason for that is because it is actually actively managed. There is a team there looking to find the best income opportunities globally, hence why the costs are higher. So on this next slide, you can see the breakdown, the percentage breakdown of the asset classes. So in our core growth portfolio, 28.73% currently is sitting in Australian equities, 29% in international equities. And the reason for that is the Australian equities has pulled back a little bit. Our banks have pulled back in the last few months, whereas the international equities side of things has continued to run on. So there's been a little slight decoupling of the Australian market compared to, say, the US market, which we generally track relatively close to. The property exposure currently in this core growth, and our growth assets in these portfolios are the equities and property. Property is a growth asset, is 14.43%. Fixed interest sits at 19, cash at 8.67, and as a total, if you look at our average weighted management expense ratio over those holdings, it comes up to 0.2% on average. Okay, so of course on top of that is the management fee of the core growth portfolio, but we are constantly trying to find opportunities out there to bring in new exchange traded funds that can do the same thing but for cheaper when they do get released. Of course, exchange traded funds are an area of the market that are only growing, and new opportunities are coming out there for us all the time. So we are looking to tinker this and get the best ETFs in here possible, and looking to actively reduce that MER over time where we can and where it's appropriate for the fund. Now, the next portfolio we'll take a quick look at here is the international equities portfolio. So the international equities portfolio, and it's been a very popular one over the last 6 months. We've had a lot of people setting up accounts and coming into this particular portfolio because still, despite how much you hear market analysts and commentators and people like ourselves in general talk about the international markets and Australians as a whole, our exposure to them, we are still underweight international markets, generally speaking, as a whole. As a group, we do not have as much as we need. Now, we have seen a number of people opening up accounts with us and going into this international portfolio as a point of rectifying that. Now, if you were to come along to us and look at opening up an international account with us and investing in this international product, right now what you'd be receiving is approximately 47% exposure to the US, 6.5% exposure to Asia. Australia does make up a small portion of that, 2.1%, and the reason for that is we are approximately 2% of the global market. Emerging markets, you get a small allocation there, 4% there. And European markets ticking up to about 23% at the moment. They have run on quite strongly, especially in the last month, after we, of course, off the back of the French election. Japan plays a little bit of a role, almost 7% there, and the UK currently sitting at 8%. So what we're trying to achieve with this international portfolio is we're not trying to be clever and time individual markets. We're trying to give people broad, diversified exposure across the globe. Okay, yes, the US and Europe are quite high, but they do make up a large portion of the global market returns. So what we're trying to do here, of course, is to give people exposure to these markets and at a really at a cheap rate as well. So if we're able to keep a lid on our expenses and the management fee, then you'll be able to get broad, diversified exposure for quite a reasonable price. And now, currently, the international equities separately managed account, if you were to go into that, the management fee on that is 0.77% per annum. And we have actively brought that down over the last year. It previously was sitting at 0.97% per annum. So we've dropped that by 20 basis points. If you put more funds in there, and this information is available on the site, the management fee does drop, and I believe it reduces all the way down to 0.65% per annum. So we like to keep that nice and low so all the returns stay in your pocket. Okay, so sitting back and looking how all this can come together, on this particular slide, I've got core and satellite portfolios. So with the core growth, I've got the core growth portfolio here. and I've got an image of the diversified income portfolio. Now, what we call our satellite portfolios are our individual asset class portfolios. So our fixed interest, our property, and our international. Okay, and then we have our actively managed portfolios. You might have taken a look at these before. They're our Intelligent Investor Equity Income portfolio and the Intelligent Investor Growth portfolio. Now, both the Intelligent Investor portfolios are 100% Australian shares, and they are hand-picked, so they're not passive, they're not tracking an index, they're hand-picked by our Intelligent Investor analysts. So, yes, we use ETFs and passive investments in our diversified portfolios, but that doesn't mean you can't marry them with, say, the fixed income, the equity income portfolio, or the equity growth portfolio as well. So you could have a core component of your portfolio, say 50 or 60% of your portfolio exposed to our diversified core growth or diversified income, depending on where you are in your investment cycle. And then you can pair that up with the equity income, say if you're very much income focused, or the growth portfolio if you're growth focused, to give you a nice balance between active and passively managed portfolios. And now the equity income portfolio with the Intelligent Investor side of things, don't let the name fool you. There is still a lot of capital growth in there. As a matter of fact, it's actually outperforming our growth portfolio. So we are not forsaking capital growth just for income. So yes, you are getting a decent yield off that, but you are still getting some capital growth. So you can pair those with a diversified income portfolio or the core growth portfolio and have a mix between passive and active. You can use the core portfolios with other fund managers out there as well. So use our core portfolio with another small cap or international or large cap stock picking fund if you like. Now I myself, I've actually chosen two of these portfolios. I've gone the equity growth portfolio and the international portfolio because I'm at a different stage of my investment cycle. Hopefully I've got a long time to go, and so I've picked these two higher growth asset classes and I'm happy to ride out the volatility. So you can also try and pick these individual satellite portfolios, so you can have a bit of fixed interest, a bit of the international portfolio, and say a bit of the equity income portfolio, and you can look to create a total portfolio out of those three, and then just look to manage it and rebalance in as you see fit. If one grows to become quite a sizable part of your portfolio, you can of course take from that and reallocate into the others, and so you can actually do your own personal rebalancing, perhaps on a monthly or on a quarterly or on a half-yearly basis. So that's how I would look at these core and satellite portfolios. You've got the one, the anchor, so that core growth, which is nice and diversified, and then you can say have your higher performing fund on the outskirts, getting you those excess returns. So that's a way to think about when you are looking at these separately managed accounts. They don't need to stand alone. Speaking of the separately managed accounts that we run, and this is my last main slide, so if you do have any questions, please submit them below and we'll get to them just after this. Also, as I mentioned at the start, there's a little green box down in the bottom, a little circle in the corner of your right-hand corner of your screen. If you click on that, you're able to chat to us. So after this, I'll be on my computer and I'll be sitting there, and anyone who's watching can start chatting to me on that, or any of my colleagues here if you do have any questions that I haven't covered off. So with the separately managed account structure, it's really important for people to understand that these are not pooled investments. For people who are familiar with using managed fund type products, where you buy into a managed fund and you have a unit price, so you are allotted a certain amount of units. With a separately managed account, that does not happen. You open up an account, you put cash in, we go out and buy shares on your behalf, so you actually have the full beneficial ownership of the individual shares, and then you can see everything that you hold, and you can see all of the transactions that we do on a daily basis for you. So there's 100% transparency. You can actually see the fees coming out, you can see the income coming in, you can see every single stock that we hold in that portfolio for you. Now, you do get the full benefit, of course, of having the management team, our investment team, managing that portfolio for you. So it's just like owning your own portfolio, but you have the guiding hand of the Intelligent Investor Analyst team or the InvestSMART investment committee making those decisions for you. Now, these are the reason why we use the separately managed account structure. There's many reasons, but one of them, though, and a really core one, is the full flexibility of income for you. So say you're in pension mode and you're living off the income produced by your portfolio. You want that to be nice and flexible so you can take that income as and when you want it. So unlike a managed fund where you'd have to, say, sell down units in that managed fund to take some profit or take out some income outside of its distribution periods, with us, you can choose a number of different ways. So you can choose, say, as and when the dividends come in, each month we can set up a dividend sweep, so an income sweep. So that means when dividends come in and income is paid into the portfolio, we'll sweep that out at the end of the month into a bank account of your choosing. Of course, the bigger dividends will be paid around the back end of the reporting seasons, so you'll have 2 dividend heavy periods. But all throughout, though, little dividends are getting paid because some companies don't pay on the same schedule as others, and of course you'll be having interest that comes through from some of the other holdings. So you can have it set up that way. A different way is you can have a monthly drawdown set up, or a quarterly drawdown, or a 6-monthly drawdown, however you like. And it's a set amount, and we'll transfer it out to you on the timing that you like. Then on top of that, you can just take ad hoc payments as well. So basically, if you don't know what your expenditure needs are going to be, and one month it's 10 grand and the next month it's 20, we can work around you and we can do that. And then of course you can combine all 3. So you can have the income sweep taking place on top of a regular drawdown from your portfolio. So, and then of course as cash comes out, we'll be rebalancing the portfolio in the background. So that's really important to us, and because it's really important to our clients. And that's one of the major reasons why we've chosen the separately managed account structure. Okay, so what I'm going to do now, I'm going to go off my presentation here, and I'll go into the questions, and we'll, as I said, please send them through. And here we go. Sorry, I've got heaps of questions here, so I'll just publish these. And then we will get around to answering some of them. So there's quite a few here actually. I think my time frame of getting this out of the way in 20 minutes is definitely going to be blown out of the water. But hopefully I've answered some of these questions as we've gone through. So from Dave, here we go. There's a lot of chatter advising caution of a correction. How have the stock pickers for the active SMAs made their selections to protect against sizable downturn on the ASX? I understand they're largely mid-caps. Are they more/less vulnerable to a sell-off? What I believe Dave is referring to here is on the Intelligent Investor portfolios. So the Intelligent Investor portfolios, you're correct, they do hold a mix of small, mid and large cap stocks. All stocks are susceptible to a sell-off. No matter if they're large or small, they'll all get hit. Now, with the Intelligent Investor growth and income portfolios, what we're trying to do there is not time markets. You'll see that they're generally 96% invested at all times. History has proven to us that if we sit back and try and time markets, we'll get it wrong. And most people who are trying to time macroeconomic events will get it wrong. So we don't try and do that. And so what we try to do to protect ourselves is hold the best, most undervalued stocks that we can at any one point in time in those portfolios. That is what we do to protect ourselves from the downsides. Now, yes, corrections will happen. Yes, the portfolio will be hit, but quality undervalued stocks will bounce back quicker than the rest. That is what we try to do because we're not here to time macroeconomic events. Now, hence why people might want to choose to use the intelligent investor portfolios with, say, those more diversified core portfolios, the core growth portfolio and the income portfolio. Of course, the diversified income portfolio is going to be much more protected in a downturn because it's holding fixed interest in cash. Okay, so think about potentially pairing those. Now, on to the next question. Is it possible to invest in an SMSF? Asked Christian. Yes, it is. So to actually invest in these separately managed accounts, all you need to do is go to the investments page of the InvestSMART website, click on the portfolio of your choice. Of course, you can blend them beyond this point, but of course, just click on the first one and hit the Apply Online button. You'll see that we're able to take investments in individual names, joint names, self-managed super funds with individuals as trustee, and self-managed super funds with a corporate structure as well. So you can just click on the Apply Now button and it'll take you through. If you have all your documentation with you, you'll be able to submit that within 10 minutes, and that is a full application. So we no longer need, generally speaking, to have people send in certified copies of ID and certified copies of, say, your trust deed for your super fund. That's no longer needed. We've streamlined the process a lot with the technology that we have here. So you can get your application done and underway within less than 10 minutes, and then you'll be hearing from me and my team. Gadu says, can I have more than one portfolio in an SMA, and how does that work with fees? Well, if Gadu was watching before, you would see that yes, you can blend more than one portfolio, and how that works with fees. Basically, you will just pay the one lot of portfolio fees. So, say if you've blended the core growth portfolio with, say, another InvestSMART portfolio, you'll get it at the 0.77% per annum rate. Now, if you blend it with the core growth with the intelligent investor growth, the percentage that you've put in the core growth portfolio will be charged at that 0.77% per annum, and the intelligent investor portfolio, because it is actively managed hand-picked stocks, is charged at 0.97% per annum. So it'll be a blend of the two depending on the weights that you have in each. Okay. Abigail says, how hard is it to build this sort of exposure, core growth portfolio, from scratch if you're a bit younger, i.e. 20s to 30s? Abigail, it depends on how good you are at saving, firstly. If you do have $5,000, you can invest in our core growth portfolio. Now, doing this outside of us is a little bit trickier because you've got transaction costs, and depending on who you're using, the likes of, say, ComSec or E-Trade or NabTrade, they all have their own brokerage costs that you will be paying. So that increases the cost of doing this for you, and increases the minimum transaction size that you really want to be doing to make it worth your while. So building the core portfolio from scratch outside of us is quite tricky with a smaller balance. Okay, so if you do want to look at building that portfolio, then I would say if you've been able to save up $5,000, that is the minimum investment currently for our InvestSMART portfolios. I'd probably say that is a more cost-effective approach for you. Tobias asks, I note your portfolios previously held emerging markets. This appears to no longer be the case, or does all world ex-US hold the exposure you are happy with in that area? Correct. Tobias, yes, that's exactly right. So the investment committee decided to move away from the emerging markets ETF and just use the all world ex-US index ETF to gain that exposure. And we are quite comfortable with that. So if our view does change, though, we will of course look to include that emerging markets ETF. Gertrude asks, how often should I consider rebalancing my portfolio without going too crazy with brokerage and the like? it's up to yourself, Gertrude, but I did mention people, just keep an eye on things. If you see that something over the last, say, 6 months has become a bigger and bigger portion of your portfolio, then look to trim it. If, say, that happens on a quarterly basis, if something has grown exponentially in a quarter, you can look to then trim it and redeploy it. So I don't think there should be a hard and fast rule around it. Of course, the transaction sizes need to make sense for yourself, but because of due to brokerage, as you have mentioned. But I don't think you should have a hard and fast rule, but just keep a general eye on it. Once a quarter, once every 6 months, as and when it suits. So I hope I've answered your question there. Is it possible to contribute funds in smaller regular amounts? Yes, it is. So our separately managed accounts do come with a regular contribution program for as little as $100 a month. So and this might help out our Abigail as well, who was talking about investing smaller amounts for someone in their 20s or 30s. So if you have that $5,000 put in to start off the fund, then you can have, say, $100 or $200 or whatever it may be coming out of your account on a regular basis every single month and going in. Now, what a lot of people expect is once that $100, for example, comes out of their account, they expect it to be invested in stocks. That's not always going to be the case. It'll go into the cash component, okay? And then when that cash component grows to a larger portion of the portfolio and is out of weight with our model portfolio, it'll trigger a buy, okay? So it's every time $100 comes in, we're not going to go out and buy stock because that'll be quite costly to you because of the brokerage. But once that cash weighting becomes a bigger portion of the portfolio and is in excess of what we want, our model that we're following for you, we will then go out and buy stock for you. So that's what will take place if you are doing a regular contribution plan. The questions just keep on coming. Rita asked, would I be able to watch this webinar in my own time after hours? Yes, Rita, you can. We'll make sure we get a copy of this to you. David asks a question that's probably more related to our upcoming Super Advice Q&A. Next week, Tony Kay will be sitting here with Max Newnham and Bruce Bremmel going over all the super changes and tax implications, etc. So David, this question, I might pass it on to them because I think it'll be better, well, you'll definitely get a better answer from them because that's not my area of expertise. Donna asks a question which we've just answered. There is a $5,000 minimum currently on the separately managed accounts to go into those. Donna then asks another question, which I'll finish off on. She says, do you charge management fees if the portfolio does not make a profit? Correct, Donna. We charge management fees because of course, the time that our analysts and our investment committee and everyone else here spends working on your portfolio. What we don't do on any of our portfolios is charge a performance fee. Okay, so we just have the 0.77% per annum and then of course decreasing on the InvestSMART portfolios. We have the 0.97% per annum and decreasing on the Intelligent Investor portfolios. The majority of actively managed funds and accounts out there will charge you a performance fee. And as well, the average on an Australian equity portfolio and an actively managed portfolio, the management fee is around 1.5%. That's the average. So we are well and truly below that, and we don't charge a performance fee. So all the performance stays in your pocket. Okay. What the management fee is that you pay covers, of course, is all of the tax reporting, all of the IT systems in place for you to view your portfolio on a daily basis, and of course for us here, if you ever have any questions, to send them through and for us to answer them. Okay, so that rounds us out. Thank you for joining us. As I did mention, please join Tony Kay and co next week as they sit down and answer your questions on super and tax-related questions during their advisor Q&A. And if you have any further questions, the little green circle in the right-hand corner of the screen, click on that and we'll be there to have a chat with you. So my name's Mitchell Sneddon. Thanks for joining us and we'll catch you next time.